You're trying to stay ahead, right? Get the crucial information without getting bogged down. Today, we're diving straight into a corner of the financial world that might seem technical, but, well, what happened there recently sent some pretty serious ripples across the entire system.
Yeah.
We're talking about the U.S. Treasury market volatility around April 8th and 9th, 2025.
Absolutely. And, we've sifted through expert reports, market data, the news, trying to get a clear picture of what went down and, maybe more importantly, what it signals. Our focus today is really understanding the causes and the potential fallout from this market stress, specifically looking at the role of leverage trading by hedge funds in what's known as the Treasury basis trade.
Because let's not forget, the U.S. Treasury market is, well, it's the bedrock of the global financial system. I mean, we're talking over $28 trillion, outstanding daily trading volumes, over $910 billion?
That's right. Huge number. So when there's a tremor here, everyone feels it.
So let's get right to it then, this Treasury basis trade.
Yeah.
What exactly is it? Can you break it down?
Sure. Think of it as a sophisticated form of arbitrage. Imagine spotting a very, very small price difference for the exact same government bond, but it's being treated in two slightly different ways, in the regular cash market and as a futures contract. The basis trade aims to capitalize on these tiny, often temporary price discrepancies.
Okay, so it's like buying the actual Treasury bond, the physical thing, and at the very same time selling a futures contract that promises to deliver that same bond later on. The idea is that those two prices should eventually line up, right?
Precisely. It's basically a bet on price convergence. You take a long position in the actual physical Treasury, that's the cash leg, and simultaneously a short position in the corresponding Treasury futures, contract the futures leg. The expectation, the whole point, is that as the futures contract gets closer to its expiration date, its price will converge with the price of the underlying cash Treasury, and the profit comes from that initial small price difference, the basis, narrowing over time.
Got it. Buy low in one market, sell high in the other, relatively speaking, anticipating they'll meet. Makes sense. Now, where does the financing come in, and why is everyone so focused on the leverage involved here?
Right, that's the critical part. These price differences we're talking about. They're incredibly small, often just a few basis points.
0.1%.
Exactly. So to turn these minuscule spreads into, meaningful profits, traders need to amplify their potential returns significantly. That's where substantial borrowing comes in, primarily through the repo market.
Repo, repurchase agreements.
That's it. Repo, short for repurchase agreement, is essentially a very short-term collateralized loan.
Okay, explain how that works in this specific context.
So a basis trader who has bought the cash Treasury can then immediately repo that security out. They sell it to another party, often a large bank, maybe a money market fund, with a binding promise to buy it back at a slightly higher price on a set date. Typically, that date is the very next day. And the difference in price, that small markup, is effectively the interest rate on this loan, the repo rate.
So they're basically using the Treasury bond they just bought as collateral to borrow the cash needed to finance most of that initial purchase.
Exactly. And because these basis spreads are so razor thin, traders heavily rely on overnight repos. They generally offer the lowest interest rates. But this introduces a crucial vulnerability: rollover risk.
Rollover risk, yeah.
Meaning this financing, this loan, needs to be renewed every single day. It exposes the trader to potential swings in repo rates and the very real risk that they might not be able to secure funding at all if market conditions suddenly get tight.
Right, because if the repo market gets shaky or lenders get nervous, that cheap funding could suddenly dry up or become much more expensive overnight.
Precisely. And this is where the heavy leverage comes into play.
Okay.
To make, say, a 2 or 3 basis point spread worthwhile, you need to magnify it considerably. This is where leverage ratios of 50.1 or even 100.1 controlling $50 or $100 of assets with just $1 of your own capital become, well, not uncommon.
Wow. 50.1, 100.1.
Yeah. And the repo market is the primary way they achieve this. But, as you can imagine, while leverage can dramatically increase potential profits, it also massively amplifies potential losses.
Of course.
This fundamental reliance on high leverage and very short-term funding is what makes this strategy inherently fragile.
So even small tremors in the market, small yield moves, can become huge shocks for those who are this highly leveraged. What kind of scale are we talking about with this Treasury basis trade? How big is this corner of the market?
Well, estimates do vary, but they all point to a very significant size. The Bank for International Settlements, the BIS, they estimated that leverage in Treasury futures, while maybe lower than pre-pandemic levels, was still around 70 times for 5-year futures and 50 times for 10-year futures after 2021.
Still incredibly high.
Very high. Now, the CFTC, the Commodity Futures Trading Commission, has noted more typical leverage ratios, maybe closer to 20 times, and the Federal Reserve has also highlighted historically high overall leverage among hedge funds, particularly concentrated in the larger ones.
Those are some eye-watering numbers, regardless of which estimate you use.
Indeed. And regarding the size of the trading activity itself, prior to March 2020, some estimates place hedge fund net short positions in Treasury futures, which is a key indicator of basis trade activity at roughly $900 billion.
Billion? With a B.
Yes. Potentially financed by something like $1.4 trillion in repo borrowing.
Wow.
More recently, Apollo Global Management estimated the size of the trade around $800 billion. Fed economists have also tracked hedge funds accumulating over $300 billion in cash Treasury holdings linked to these strategies since early 2022. And by May 2023, CFTC data showed hedge fund short futures positions nearing $715 billion again.
So we're talking potentially hundreds of billions, maybe even touching on $1 trillion, tied up in this specific strategy. What's been fueling this growth? Why so big?
A primary driver seems to be the substantial increase in U.S. government debt issuance. Just the sheer volume of treasuries hitting the market. As the supply has grown significantly, basis traders have, played a role in absorbing some of that new supply. This has been particularly evident during periods of the Federal Reserve's quantitative tightening, or QT, when the Fed itself was reducing its holdings.
So they step in where the Fed steps out, in a way.
In a sense, yes. So the expansion of the basis trade is closely linked to the very structure and scale of the modern treasury market and how the government finances its debt.
Okay, so we have a clearer picture now. What the basis trade is, how it uses massive leverage via repo, and its sheer size. Let's focus back on April 8th and 9th, 2025. What exactly happened in the treasury market during those 2 days? What did the volatility look like?
Right. Those 2 days saw notable and pretty unusual volatility, especially in the benchmark 10-year treasury yield. Looking at the timeline, on Friday, April 4th, the 10-year yield was around 4.01%, pretty stable. By the end of Monday, April 7th, it had jumped to about 4.15%. That's a significant one-day increase, 14 basis points.
Okay, big move for one day.
Yeah. Then on Tuesday, April 8th, it climbed further to approximately 4.26%, another 11 basis points. The most intense period, though, seems to have been Wednesday morning, April 9th. Reports suggest the 10-year yield approached 4.50%.
Approached 4.5%.
Wow. It did then retreat somewhat, closed around 4.34% later that day, but by April 10th, it remained elevated, about 4.4%.
So a really rapid and significant climb in yields in just a few days. And it wasn't just the 10-year Treasury that was moving like this?
Correct. We saw rising yields pretty much across the entire yield curve. The 30-year Treasury yield reached over 4.70%, maybe 4.71%, 4.72% briefly. The 2-year yield also climbed, hitting 3.91% on April 9th. Even the yields on TPS, the inflation index Treasuries, saw noticeable increases.
But what was particularly unusual, as I recall reading, was the behavior of the Treasury market relative to the stock market. Normally, they move in opposite directions during stress, right? The classic flight to safety, sell stocks, buy bonds, yields go down. That didn't happen this time, did it?
Exactly. That's what made this episode so concerning and, frankly, quite puzzling at the time. Treasury yields were rising sharply at the same time that the U.S. stock market was also declining and experiencing heightened volatility. This breakdown of the typical safe haven dynamic strongly suggested that, unusual pressures were at play, likely involving forced selling rather than just a broad reassessment of the economic outlook.
Yeah, news reports from that period definitely painted a dramatic picture. I remember seeing terms like twitchy trading, chaos, and even President Trump commenting that the bond market was getting a little queasy. It certainly didn't sound normal.
No, it didn't. The reports also indicated a noticeable deterioration in market liquidity. Data from platforms like TradeWeb, for instance, showed wider bid-offer spreads for actively traded treasuries.
Meaning it was harder to trade.
More expensive and more difficult to execute large trades quickly without moving the price significantly. That points to a market under stress, its usual smooth functioning impaired.
And what about the Treasury futures market? Did that offer any clues?
Yes, absolutely. There was a significant drop in open interest in 5-year Treasury note futures. Something like 280,000 contracts were closed out on April 8th and 9th alone.
Closed out quickly.
Very quickly. This kind of rapid decline in open interest strongly suggests extreme deleveraging. It indicates that a large number of participants, likely including those leveraged basis traders we've been discussing, were rapidly closing out their futures positions, unwinding.
We also heard that a Treasury auction around that time didn't go particularly well. Was that related?
Yes. The auction of 3-year Treasury notes on Tuesday, April 8th, was reportedly met with weaker demand than usual. Poorly received was the term used. While it wasn't necessarily the sole cause of the broader market volatility, it likely contributed to the overall nervousness. It sort of fueled speculation about potential large sellers already being active in the market or perhaps unwilling to step in.
Okay, so if we put all these pieces together, rising yields, stocks falling, poor liquidity, futures deleveraging, a weak auction, what were the primary factors believed to have triggered this period of turmoil?
Well, the prevailing view is that it was really a confluence of interconnected factors hitting at once. The forced unwinding of those highly leveraged basis trades we discussed, that was likely a key driver.
Because rising yields caused them losses.
Exactly. As Treasury yields rose, these traders would have faced losses on their short futures positions. That triggers margin calls from the clearinghouses. At the same time, they might have faced stress in the repo market that was funding their long cash Treasury positions, maybe higher rates, maybe less availability. This would have compelled them to sell their cash treasuries to raise funds or just cut their overall exposure.
Which then pushes yields up even more, a feedback loop.
Precisely, adding further upward pressure on yield.
And the speculation surrounding foreign selling, particularly by China, that was also a big part of the narrative at the time.
Yes, it definitely was. Amidst the ongoing trade tensions, there was considerable speculation that China might have been selling U.S. treasuries, perhaps as a retaliatory measure or maybe just diversifying. The less than stellar auction results also sort of fed into this line of thinking. However, as we'll probably discuss in more detail, concrete evidence of large-scale Chinese selling during those specific days remained elusive. The data lags too much.
Right. What about the broader economic picture? Policy uncertainty, tariffs.
Those likely played a role too. Concerns about the potential impact of tariffs on inflation and just the general uncertainty surrounding trade policy that could certainly contribute to nervousness in the bond market. Higher inflation expectations tend to push bond yields upward anyway, as investors demand more compensation.
And uncertainty just makes people generally more cautious.
Right. More risk-averse, leading to portfolio adjustments. You might also have seen just general forced selling, people needing cash to cover losses in other markets like stocks.
So it sounds like a bit of a perfect storm brewing. You have trade war anxieties, maybe causing some initial selling, which then puts significant strain on those highly leveraged basis traders.
Yeah.
Forcing them into a rapid deleveraging process that further destabilizes the market and even disrupts the traditional safe haven behavior of treasuries. Is that a fair summary?
I think that's a very accurate way to summarize it. The amplification effect of leverage is absolutely crucial here. Initial uncertainty, maybe some early selling pressure, leading to stress on these highly leveraged players, triggering forced deleveraging, and ultimately resulting in more widespread price pressures and that unusual breakdown of the safe haven dynamic that we observed.
This whole episode really highlights the potential systemic risks that can be, maybe hidden is the wrong word, but certainly embedded within these leveraged basis trades. Just how does all that leverage create a threat to the broader financial system?
Well, the fundamental issue, as we've touched on, is how extreme leverage magnifies the impact of even relatively small market movements. A seemingly minor increase in yields or a slight rise in repo funding costs can translate into substantial losses for a highly leveraged fund, potentially wiping out their capital. This then sets off that deleveraging process we've discussed. Margin calls from clearinghouses on their futures position.
They need more collateral.
Exactly. And potential funding difficulties in the repo market. Maybe rates spike, maybe lenders pull back. To meet these demands, or simply to cut their risk, they are compelled to sell their treasury holdings and buy back their futures contracts, often very quickly.
And when a significant number of these highly leveraged players all try to do that at the same time, that's when the real problems can escalate, right?
Precisely. You can quickly get into what's known as a margin spiral. As market volatility increases, the clearinghouses, acting prudently from their perspective, may raise margin requirements across the board to protect themselves.
Which forces traders to find even more cash.
Yes. If they don't have it readily available, they have to sell more assets, which can drive prices down further, increase volatility more, potentially triggering another round of margin increases from the clearinghouse. It's a self-reinforcing negative cycle.
A downward spiral.
Exactly. We saw similar dynamics play out in the repo market disruptions back in September 2019, and again, much more severely in the widespread market turmoil of March 2020.
And we've touched on how crucial the repo market is for funding these trades. What makes it so vulnerable in these kinds of stress situations?
It's that heavy reliance on overnight repo financing. It exposes traders to the risk that this funding can become much more expensive or even completely unavailable almost instantly. If lenders become unwilling to lend, maybe due to concerns about the borrower or just general market fear, or if they demand significantly higher rates. That's exactly what happened in both 2019 and 2020. Funding just dried up or became prohibitively expensive for some.
And if you can't roll over your repo financing, basically renew your loan for the next day,
You're forced to liquidate your Treasury holdings. Sell them. Regardless of the price or market conditions, that adds to the selling pressure.
You also mentioned earlier that the traditional shock absorbers in the market, the large primary dealers, the big banks, might not have the same capacity as they once did. Why is that?
That's largely a consequence of regulations put in place after the 2008 financial crisis. Think about rules like the supplementary leverage ratio, the SLR.
That limits their overall balance sheet size relative to capital.
Right, and a higher capital surcharges for the big global systemically important banks, the GSIBs. Now, these rules were designed quite reasonably to make the banking system safer and more resilient, but an unintended consequence seems to be that they've somewhat constrained the balance sheet capacity of these primary dealers. These are the guys who traditionally play a crucial role in market making and absorbing large trading volumes, especially in the Treasury market.
And the Treasury market itself has gotten much bigger.
Dramatically bigger. So you have this potential mismatch. A growing market, but maybe constrained dealer capacity to handle large, sudden waves of selling, like those from rapid deleveraging by leveraged funds.
So the cash treasuries, the futures market, the repo market, they're all deeply interconnected. Stress in one area spills over quickly. And leverage acts as this really dangerous amplifier throughout the whole system. It almost sounds like the regulations that strengthen the banking sector might have inadvertently pushed some of the risk into the less regulated non-bank sector, like these hedge funds. Is that fair?
That's a key point that many analysts and policymakers have raised. It's a very plausible argument. By making the banking sector more resilient through stricter capital and leverage requirements, regulations may have indeed encouraged more leverage-intensive activities, like the basis trade, to migrate towards less regulated parts of the financial system, hedge funds being a prime example.
And you brought up the dash for cash in March 2020 several times. How did the unwinding of the basis trade specifically contribute to that period of intense market dysfunction?
The rapid unwinding of Treasury basis trades was definitely a significant contributing factor to the severe disruptions we saw back then. The initial shock of the pandemic led to massive market volatility across, all asset classes. This triggered those sharp and sudden increases in margin requirements on Treasury futures, in some cases. Margin reportedly doubled almost overnight.
Doubled, wow.
Yeah. This, combined with severe stress in short-term funding markets, particularly repo, forced those highly leveraged basis traders to deleverage their positions very, very quickly. Estimates suggest they sold tens, maybe even hundreds of billions of dollars worth of treasuries during that short period.
Huge selling pressure.
Massive.
Yeah.
And we also saw a substantial reduction in hedge fund net short positions in Treasury futures, confirming they were unwinding the trade.
And what was the direct impact on the Treasury market itself during that time? What did it look like on the screens?
It was dramatic. Liquidity essentially vanished. Bid-ask spreads, the difference between buying and selling prices soared. Some reports said 10 times their normal levels.
So incredibly expensive to trade.
And the depth of the market, the size of trades you could execute without moving the price, significantly just collapsed. Also, that normally tight relationship between the prices of cash treasuries and their corresponding futures contracts broke down significantly. The basis, the spread they trade on, widened dramatically, over 100 basis points in some cases.
100 basis points. That's huge compared to the few they normally target.
Absolutely huge. It basically showed the arbitrage wasn't working. The market was broken. And it ultimately required massive, unprecedented intervention by the Federal Reserve to restore even a semblance of normal market functioning.
So these leveraged players, it sounds like you might call them fair weather friends to the market. They provide some grease, some liquidity when things are calm, but they are nowhere to be found or even actively making things worse when a significant market stress event occurs.
That's a very apt analogy. I think it captures the dynamic quite well. Their business model, built on that high leverage and the assumption of readily available cheap funding, It compels them to deleverage and demand liquidity precisely when the market is most stressed and liquidity is scarce. So they end up amplifying volatility and contributing to the very market dysfunction they might otherwise help to alleviate in more tranquil periods. It's pro-cyclical.
Now, let's shift focus a bit to the geopolitical angle. That speculation surrounding China's holdings of U.S. Treasuries during the April 2025 volatility was definitely a prominent narrative. What do the actual figures tell us about their position? Who are the big holders?
Right. Well, looking at the official data, as of January 2025, which would have been the latest available data around the time of the April events, Japan was actually the largest foreign holder of U.S. Treasury securities, holding over $1.1 trillion.
Okay, Japan number one.
Mainland China held approximately $760 billion, making it the second largest foreign holder. The UK is usually third. It's important to note that while $760 billion is obviously a substantial amount, China's holdings have actually been on a downward trend for years, really since 2013, when they peaked at over $1.3 trillion.
So they've been gradually reducing for a long time.
Yes. So even by January 2025, their holdings were at levels not seen in over a decade. Interesting, the data for January even showed a slight increase from December 2024, though still down compared to January of the previous year.
Okay, so while their holdings are significant, they've been gradually reducing their exposure over the long term. Now, during those volatile days in April, the rumor mill was definitely working overtime regarding potential Chinese selling. Was there any concrete evidence to support those claims?
That's the crucial point. While the speculation was widespread, you saw it in headlines, on trading floors. Fueled by the ongoing trade tensions and that weaker-than-expected three-year Treasury auction we mentioned. There was no definitive evidence of large-scale Chinese selling during those specific days of volatility.
Because the data comes out much later.
Exactly. Official U.S. Treasury data on foreign holdings, the TDUNC data, is released with a significant delay, typically a lag of several weeks, maybe 6 weeks or so. So the actual figures for April wouldn't have been available until, late May or June 2025.
So at the time, it was primarily speculation driven by the existing geopolitical climate and market jitters.
Largely, yes. And there were several counter-arguments, even at the time, to the idea that massive Chinese selling was the primary driver of the April volatility. For one, as we've discussed at length, the forced unwinding of leveraged basis trades seemed like a more immediate and plausible trigger for the specific market movements we saw.
Made more sense mechanically.
Right. Additionally, the U.S. dollar actually strengthened during that period, which is not typically what you'd expect if a major holder like China was aggressively liquidating dollar assets. Usually that would weaken the dollar.
Good point.
Furthermore, the specific pattern of yield movements across different Treasury maturities didn't perfectly align with what you might typically observe during a concentrated sell-off by a single large entity. And as we noted, China's reduction in its Treasury holdings has been a gradual, multi-year process, not typically characterized by sudden fire sales. Plus, the most recent data available at the time even showed that slight increase in January.
But even without confirmed large-scale selling, the mere perception that China might be selling or could sell, that could still contribute to market nervousness and volatility, couldn't it?
Oh, absolutely. In an environment of heightened geopolitical tensions, the very possibility of a major holder like China reducing its exposure, maybe for political reasons, that can definitely contribute to market jitters and increased volatility. This perception of geopolitical risk can influence investor behavior. It could potentially lead to a higher risk premium being demanded by investors to hold U.S. debt, even without any concrete action being taken. Perception matters.
And in the context of the ongoing trade war, there's always this background concern about countries potentially weaponizing their Treasury holdings. How realistic is that scenario, really?
It's a recurring theme, right? The idea that a large holder like China could use its Treasury holdings as a form of economic leverage against the U.S. However, the feasibility, and perhaps more importantly, the potential consequences of such an action for China itself are highly debatable.
It could backfire.
It could seriously backfire. Aggressive and rapid selling of U.S. Treasuries would likely destabilize global financial markets significantly. That could, in turn, severely harm China's own economy through disruptions to its massive export sector and a potential devaluation of its remaining, still very large, foreign currency reserves, many of which are in dollars.
So it might be mutually assured financial destruction to some extent.
That's one way to think about it. Moreover, as the overall size of the U.S. Treasury market continues to grow, and as China has been gradually reducing its relative holdings over time, The actual impact of their actions on U.S. Treasury yields might be diminishing compared to, say, a decade ago. Domestic U.S. economic factors, Fed policy, and broader trends in global portfolio diversification likely play an increasingly significant role in determining Treasury yields today.
Okay, that provides some important context on the China angle.
Mhm.
Let's turn our attention now to the Federal Reserve. You mentioned their very aggressive interventions during the March 2020 crisis. Can you recap the specific actions they took and maybe talk about the intended and perhaps unintended consequences?
Sure. In March 2020, facing that severe dash for cash and significant disruptions across multiple critical financial markets, the Fed really pulled out all the stops. They initiated massive asset purchase programs, QE buying over $1.6 trillion in U.S. Treasuries and agency mortgage-backed securities in just a couple of months,
Injecting huge amounts of liquidity.
directly into those markets to help stabilize prices and absorb selling pressure. They also dramatically expanded their repo operations, offering up to $1 trillion per day to ensure short-term funding markets didn't seize up. Crucially, they rolled out a whole suite of emergency lending facilities, things like the Primary Dealer Credit Facility, PDCF, the Money Market Mutual Fund Liquidity Facility, MMLF. Some of these were even backstopped by the U.S. Treasury, which meant taxpayer funds were potentially at risk if losses occurred.
A significant step.
Very significant. Additionally, they established and expanded U.S. dollar swap lines with foreign central banks to help ease dollar funding shortages globally. And finally, they provided temporary regulatory relief to banks, most notably excluding U.S. Treasuries and central bank reserves from the calculation of the supplementary leverage ratio, SLR, for large banks, freeing up some balance sheet capacity.
So, a truly comprehensive, multi-pronged approach. And it was generally credited with helping to calm things down significantly, right? Preventing a worse meltdown.
Yes. It is widely acknowledged that these interventions were crucial in stabilizing financial markets at that critical juncture. They alleviated the severe funding strains that had emerged. The large-scale asset purchases helped absorb the selling pressure, and the emergency lending facilities provided vital support to various segments of the financial system facing extreme liquidity challenges. They worked in that sense.
But you also touched earlier on this concept of moral hazard. How might these kinds of forceful interventions by the Fed potentially create that problem down the line?
Right, the moral hazard concern. The worry is that by stepping in so decisively, so forcefully, to prevent market collapses, the Fed might inadvertently create an expectation among market participants, traders, banks, funds, that they will always be there to backstop the market if things go really wrong.
The Fed put, as they call it.
Exactly. This expectation of future bailout could potentially encourage investors and financial institutions to take on excessive levels of risk in the future. They might think, well, if it blows up, the Fed will step in and limit the damage.
So it could encourage the very leverage we've been talking about.
Precisely. There's a concern that the very fact the Fed intervened so aggressively in 2020 might lead leveraged players, like basis traders, to take on even more risk going forward, believing there's a safety net. This can weaken market discipline, encourage higher leverage, particularly in those less regulated parts of the system, and it can blur the lines between addressing temporary liquidity problems and effectively supporting potentially insolvent entities.
But what's the counter-argument? Why do some economists and policymakers defend the Fed's actions in situations like March 2020, despite these moral hazard risks?
The primary defense is really about systemic risk. In truly systemic crises, the argument goes, the potential for widespread economic damage hitting jobs, businesses, the whole economy is so severe that the central bank has a responsibility to act forcefully to prevent a complete collapse of the financial system. It's the lender of last resort function. The argument is that the overriding goal is to restore the basic functioning of critical markets for the benefit of the entire economy, not necessarily to rescue specific firms or traders, even if those firms do happen to benefit as a consequence of these broader market stabilization efforts.
The cure might have side effects, but the disease is fatal.
That's a good way to put it. Furthermore, proponents would point out that many of the emergency lending facilities established in 2020 involved lending against good collateral, often at penalty interest rates. The intention there was to introduce some element of market discipline and discourage firms from relying on these facilities unless absolutely necessary.
So it's a really delicate balancing act then, trying to prevent a systemic meltdown without creating incentives for more reckless behavior down the line. Are there any specific policy proposals or ideas about how to try and navigate this tension more effectively in the future, maybe break that cycle?
Yes, there are several ideas that have been floated and discussed. One interesting concept is hedged purchases. The idea is, if the Fed needed to intervene in the Treasury market again to ease basis trade stress, they could buy the distressed cash treasuries, but simultaneously sell Treasury futures contracts.
So targeting the specific cash futures dislocation.
Exactly. The aim would be to directly ease the pressure on basis traders and narrow that cash futures basis, without significantly expanding the Fed's overall balance sheet or necessarily altering the broader stance of monetary policy. It's a more targeted approach.
Interesting.
There's also ongoing debate about the design and accessibility of the Federal Reserve Standing Repo Facility, the SRF. Questions like, who should be eligible to use it? Under what conditions? How can it provide a more predictable permanent liquidity backstop without inadvertently fueling excessive risk-taking beforehand?
Getting the parameters right is key.
Absolutely. But it's a continuous challenge. Every intervention, arguably, carries the risk of reinforcing those expectations of future bailouts, the so-called ratchet effect. It potentially makes it more difficult for the Fed to credibly step back and allow market forces, even painful ones, to play out in future stress events. It highlights that inherent tension between the Fed's mandate for financial stability and the need to maintain its independence, avoid credit allocation, and not be seen as picking winners and losers.
This leads us quite naturally into the ongoing debate about whether these Treasury basis traders are ultimately a net positive or a net negative for overall market liquidity and functioning. You hear strong arguments on both sides.
That's absolutely right. It's a central debate. On one hand, proponents argue that by actively arbitraging those small price differences, basis traders actually contribute to more efficient price discovery. They help keep the cash and futures markets tightly linked. They also point out that basis traders represent a significant source of demand for newly issued cash treasuries, which helps the market absorb the huge volume of government debt being issued.
So they help the Treasury finance the deficit.
Indirectly, perhaps. Their activity might help lower the government's overall borrowing costs, arguably. Additionally, their activity in the futures market can make it easier and cheaper for other market participants, think pension funds, insurance companies, to hedge their interest rate risk effectively.
Okay, so those are the arguments for their contribution. But the critics, as we've already discussed quite a bit, raise some pretty significant concerns, especially around that leverage issue.
Precisely. The primary concern, which really came to the fore in March 2020 and again surfaced in April 2025, is the inherent fragility created by the extremely high levels of leverage employed in these strategies. When market conditions become stressed, these highly leveraged players are often forced to deleverage very rapidly. And this forced selling, this rapid unwinding, can actually consume liquidity in the market at the worst possible time, exacerbating the problems.
So they take liquidity when it's needed most.
Exactly. Their pro-cyclical behavior adding liquidity when things are calm, but withdrawing it or even actively adding to the stress during crises is a key worry for regulators. Furthermore, the sheer potential size of their unwinds can strain the capacity of even the largest primary dealers to effectively intermediate those trades, raising the potential for systemic risk to spread through the interconnected markets.
So they're a bit like that fair weather friend analogy we used earlier when it comes to providing liquidity. They're there and helpful when the sun is shining and things are calm and predictable, but they disappear, or, as we've seen, can even make things considerably worse when a real market storm hits.
That's a very succinct and, I think, accurate way to put it. And this whole debate really boils down to that fundamental trade-off in finance, the tension between market efficiency and financial stability. Leveraged arbitrage strategies like the basis trade can contribute to greater efficiency in normal times, maybe narrower spreads, but the very mechanisms they rely on, high-leverage short-term repo funding, can introduce significant vulnerabilities that threaten the stability of the entire financial system when adverse conditions inevitably arise.
Now let's talk specifically about the 10-year U.S. Treasury yield. You mentioned several times it's a really critical economic benchmark. Why is this particular interest rate so important in the broader financial landscape? Why do we focus on it so much?
It truly is a central reference point in the global financial system. For most individuals, the most direct impact they feel is probably through mortgage rates, particularly the 30-year fixed-rate mortgage, which has a very strong and direct correlation with the 10-year Treasury yield. They tend to move together, though not perfectly.
Okay, mortgages. What else?
Its influence extends far beyond just the housing market. It serves as a fundamental benchmark for pricing all sorts of other borrowing costs throughout the economy. Think corporate bonds companies borrowing money, auto loans, even some types of consumer credit are implicitly linked. It also directly affects the U.S. government's own cost of borrowing money when it issues new debt.
And it's also seen as a key indicator of the overall health and direction of the economy itself, isn't it?
Exactly.
The 10-year Treasury yield is probably the most widely watched gauge of investor sentiment and expectations about future economic growth and inflation. Generally, a rising yield often suggests investors anticipate stronger economic growth, maybe higher inflation down the road, while a falling yield can signal more pessimistic expectations about the economy, or maybe that flight to safety mentality where investors prefer the security of government bonds over riskier assets.
And the Fed watches it closely, too.
Very closely. The Federal Reserve and other central banks pay extremely close attention to movements in the 10-year yield when they're formulating their monetary policy decisions. It's a key input.
So when we see those sharp and rapid increases in the 10-year yield like we did in April 2025, especially if they don't seem to be driven by really strong underlying economic fundamentals, like a booming economy, that can be a real cause for concern. Why is that the case? Because it directly translates into higher borrowing costs across the entire economy almost immediately. And that can have a significant dampening effect on economic activity. Higher mortgage rates make buying a home less affordable, potentially cooling down the housing market, which is a big part of the economy. Businesses face higher costs for borrowing to invest in new equipment or expand their operations. That can curtail investment. Consumers might become more hesitant to take out loans for big-ticket purchases like cars if interest rates are significantly higher.
So it can slow things down?
It can. It can lead to increased volatility in financial markets more broadly as asset prices readjust. And if these higher borrowing costs are sustained and weren't justified by growth, they could ultimately contribute to a more significant economic slowdown or even recession.
And you mentioned that during the April 2025 volatility, the 10-year yield approached 4.50% and the 30-year yield even briefly went above 4.65%. The user who prompted this deep dive specifically flagged that 4.65% level as a threshold of concern. What's the potential significance of that particular level?
Well, the user's focus on the 4.65% level for the 30-year yield is likely tied to its role as a very long-term benchmark and its sensitivity to long-run inflation expectations and the broader economic outlook. Crossing certain psychological levels can matter. While the 10-year yield didn't quite reach that specific level during the April 2025 event, the rapid and significant move towards it, and the fact the 30-year did exceed it, particularly during a period when, as we discussed, you might normally expect Treasury yields to be falling due to concerns in the stock market. That was a strong indication of market dysfunction and potential stress. It wasn't a healthy rise in yields.
It signaled something was wrong in the plumbing.
Exactly. When yields rise sharply due to technical factors like forced selling or liquidity issues, rather than reflecting improving economic prospects, it can transmit that financial stress to the real economy very quickly by making borrowing more expensive for everyone unnecessarily. That's why those rapid increases we witnessed were so concerning.
And you mentioned the relationship between the 10-year Treasury yield and actual mortgage rates isn't always a direct one-to-one lockstep movement, is it? There's a spread involved.
That's correct. There's what's known as the mortgage spread, which is the difference between the average mortgage rate borrowers pay and the yield on the 10-year Treasury. This spread exists because mortgages are inherently riskier and less liquid than U.S. government bonds.
What goes into that spread?
It reflects several things. The additional yield investors demand for holding mortgage-backed securities, MBS, compared to treasuries, compensating them for prepayment risk, people paying off mortgages early, and default risk. It also reflects differences in market liquidity between MBS and treasuries. And then there's another layer, the spread between the yield on MBS and the actual interest rate that borrowers pay. This covers the lender's operational costs, servicing fees, and, of course, their profit margins.
And this spread isn't constant.
No, not at all. It can open or narrow depending on various market conditions, the overall appetite for risk among investors, perceived risks in the housing market, and even the shape of the Treasury yield curve itself. For instance, sometimes a flat or inverted yield curve can lead to a wider mortgage spread over the 10-year yield, partly due to increased expectations of refinancing activity.
So even if the 10-year Treasury yield doesn't hit some specific high threshold, significant changes in that mortgage spread can still have a very substantial impact on homebuyers and the broader housing market. It's another moving part.
Precisely. It's a more nuanced relationship than simply tracking the 10-year yield in isolation. The mortgage spread provides crucial additional information about the true cost of borrowing for housing.
Okay. So as we start to wrap up and look ahead, what's the overall assessment of the stability of the U.S. Treasury market, particularly in light of what we saw in April 2025? And what are some of the key potential risks or vulnerabilities that could trigger similar or maybe even worse events in the future?
Well, I think the overarching risk profile of these leveraged Treasury basis trades really presents that double-edged sword we discussed. While they may offer some benefits to market efficiency, maybe tighter spreads under normal conditions, they introduce a significant vulnerability to the overall stability of the financial system. That's due to the inherent high leverage involved and the potential for disruptive, rapid unwinds when market stress inevitably occurs.
We've seen the evidence.
We've witnessed this dynamic clearly in April 2025 and even more starkly in the severe events of March 2020. The potential for disruption is real.
And what are some of the key triggers we should be watching for? What could potentially set off future episodes of instability in this crucial market?
Several factors could act as catalysts, I think. We could see unexpected external shocks, think major geopolitical events, another pandemic, sudden and sharp economic downturns. Large, concentrated sales of Treasury securities could be a trigger, whether driven by further forced deleveraging from leveraged participants like basis traders, or perhaps actual large-scale selling by major foreign holders, if that were to occur. Either could overwhelm market absorption capacity temporarily.
Funding is key too, right?
Absolutely. Disruptions in short-term funding markets, particularly the repo market where these trades are financed, remain a critical vulnerability. Also, a sustained increase in overall market volatility could trigger problems as it leads to higher margin requirements from clearinghouses, potentially forcing deleveraging. And finally, just the continued rapid growth in the supply of U.S. Treasury debt itself could eventually strain the market's ability to absorb it smoothly, potentially making it more susceptible to shocks.
And how do the various policy responses and regulatory frameworks interact with all this and trying to mitigate these risks? It seems like a complex web.
It is incredibly complex. They're all critical pieces of the puzzle. Federal Reserve policies are huge. Their approach to market interventions, their broader monetary policy stance, the design and availability of facilities like the standing repo facility, these directly influence market conditions and risk perceptions. Then you have financial regulations. Bank capital requirements like the SLR, the ongoing efforts to mandate central clearing for more Treasury transactions.
Concern clearing is supposed to help, right?
It's intended to enhance resilience by mutualizing risk and increasing transparency, yes. Though implementation has challenges. There are also ongoing debates about whether bank regulations have gone too far or not far enough. And then there's the evolution of the market structure itself, the rise of electronic trading, high-frequency firms, the growing role of non-bank participants like hedge funds. All these shape how the market behaves under stress.
It sounds like there's definitely a growing awareness among policymakers and regulators of these underlying fragilities. And there are ongoing efforts to implement reforms aimed at strengthening the market. But is the pace of these adaptations keeping up with the evolving nature and potential magnitude of the risks? That seems to be the million-dollar question.
Or maybe trillion-dollar question, given the market size.
Yeah.
It is the central challenge. While there's certainly increased attention being paid to these vulnerabilities, and while important reforms like the push for greater central clearing are underway, there is a legitimate concern, voiced by many observers, that the speed at which these adaptations are being designed and implemented might not be sufficient, especially given the continued substantial growth in government debt and the concentration of significant leverage in that less regulated non-bank financial sector. The risks might be evolving faster than the solutions.
And on that point about the underlying mechanisms of risk being increasingly understood, as you've explained them so clearly today, does that mean we can be reasonably confident? Or is that too optimistic?
I think that would be too optimistic, unfortunately. While our understanding of the mechanisms that can contribute to Treasury market instability leverage, funding stress, amplification has certainly improved, and we can identify potential vulnerabilities with greater clarity now. Predicting the precise trigger, the exact timing, and the ultimate magnitude of the next significant market disruption remains incredibly difficult, probably impossible. The financial system is just too complex, too interconnected globally. Unexpected events, novel interactions, or just plain bad luck can still have cascading and surprising effects.
So knowing the risks doesn't mean they won't bite you.
Exactly. So while we might have a better grasp of the types of vulnerabilities that exist, we should certainly avoid complacency. We cannot predict with certainty exactly how or when the next crisis will unfold or what it will look like.
So, to bring it all together then, This deep dive into the Treasury basis trade really reveals a fascinating but clearly potentially risky aspect of our global financial plumbing. The volatility we witnessed in April 2025, echoing some of the market stresses of March 2020, really underscores the double-edged nature of this high-leverage strategy. Efficiency versus fragility. The role of foreign holdings, particularly China's, adds another layer of geopolitical complexity and market perception, even if the direct impact of their selling in April wasn't definitively confirmed.
Right. The speculation itself matter.
The Federal Reserve's interventions, while often seen as necessary to prevent broader market meltdowns, definitely raise those important, thorny questions about moral hazard and future risk-taking.
A constant balancing act for them.
And the debate continues, as you said, about whether these basis traders ultimately enhance or detract from overall market liquidity and stability, especially during times of stress. Are they friends or foes?
Depends on the weather, perhaps.
And all of these complex dynamics ultimately center around, or are reflected in, that benchmark 10-year Treasury yield a truly pivotal number for the entire global economy.
Precisely. And perhaps the most critical takeaway, the provocative thought maybe to leave listeners with, is to consider that inherent tension. How the very pursuit of efficiency in financial markets, especially when coupled with significant leverage and interconnectedness, can inadvertently sow the seeds of its own instability. Finding the appropriate balance through effective regulation, smart market design, and diligent oversight in this constantly evolving global financial landscape, well, that remains the fundamental and ongoing challenge for everyone involved.
It really does make you think about the broader implications, how these intricate market dynamics affect overall financial stability, and maybe even our own understanding of the risks embedded, sometimes unseen, within the system. If you found this deep dive valuable and want to learn more, we certainly encourage you to explore some of the expert reports, market data, and news articles that informed our discussion today. There's always a great deal more to unpack in this important corner of the financial world.